Hello and welcome to the session. Financial Management LO2 determine alternative sources of business finance, including contemporary methods for different business situations. Are you aware of the diverse financial sources available to businesses today? This video explores the internal and external funding options for SMEs and large organizations. Discover how these financial strategies impact business operations and long-term success. Internal finance sources are funds generated within the organization. They reduce dependency on external finance and preserve control. Common types include working capital management, asset sales, and retained profits. These methods improve liquidity and financial independence. However, they may limit growth potential and involve opportunity costs. Working capital is a key short-term internal finance source for SMEs. It involves cash collection, supplier negotiations, and inventory control. This approach enhances liquidity and cash flow discipline. However, it might damage customer relationships if managed aggressively. Effective management is crucial for business survival. Selling underused assets provides a one-off cash inflow. This method avoids debt and ownership dilution. It improves asset efficiency but is non-recurring. Potential risks include selling below market value. Asset sales are strategic for both SMEs and larger organizations. Retained profits are a primary long-term internal finance source. They allow reinvestment into operations and expansion. This method maintains ownership and control. However, it depends on profitability levels. Shareholders might be dissatisfied with reduced dividends. Internal finance carries an opportunity cost despite no interest payments. Retained profits could have been distributed to shareholders. Working capital could serve other purposes. Assets might generate future returns if not sold. Financial management must assess value creation. External finance involves raising funds from outside the organization. It's necessary when internal finance is insufficient. Options depend on size, risk appetite, and funding purpose. Short-term sources include overdrafts and trade credit. Long-term sources involve debt and equity finance. Overdrafts allow withdrawing more than available funds. They offer flexibility for cash flow gaps. However, they have higher interest rates. Short-term loans provide fixed finance for defined periods. Trade credit allows delayed payment for goods and services. Lease finance and hire purchase reduce upfront capital needs. They preserve cash flow but have higher long-term costs. Debt finance involves mandatory repayments with interest. Convertible debt offers flexibility by converting to equity. Equity finance involves selling ownership stakes. Choosing between debt and equity impacts control and risk. Debt is cheaper but increases financial risk. Equity reduces pressure but dilutes ownership. Risk-averse organizations may prefer equity. Predictable cash flows might favor debt to maximize returns. Contemporary finance expands funding options beyond traditional methods. Islamic finance prohibits interest and focuses on ethical investment. Internet-based finance reduces barriers between borrowers and investors. Peer-to-peer lending connects borrowers with lenders directly. Crowdfunding raises funds from many contributors online. The Internet transforms access to finance for SMEs and startups. Peer-to-peer lending offers faster finance access. Crowdfunding engages public support for startups. These methods bypass traditional banks. However, they involve higher risks and limited protection. Sale and leaseback releases capital tied in assets. It retains operational use while improving liquidity. However, it creates long-term lease commitments. Venture capital provides equity finance to high-growth businesses. It offers strategic support but dilutes ownership. Franchising is a hybrid financing and growth model. Franchisees fund expansion by investing their capital. It reduces capital requirements for franchisors. However, it involves reduced operational control. Franchising is effective in service and retail sectors. Contemporary finance methods increase flexibility and accessibility. They are particularly useful for SMEs and growth-oriented organizations. However, each method carries risks related to control and complexity. Financial management must match these options to objectives. Selecting finance based on availability alone is ineffective. Startups often lack access to traditional bank finance. Internal finance like owner's capital is the first option. Crowdfunding and peer-to-peer lending are external alternatives. Venture capital suits high-growth SMEs but involves ownership loss. These sources provide substantial funding for growth. SMEs experience cash flow volatility due to delayed payments. Short-term external finance is more appropriate in these situations. Overdrafts offer flexibility, while trade credit allows delayed payments. Asset-based finance like leasing preserves cash flow. These methods increase long-term costs. When SMEs plan to expand, longer-term finance is needed. Retained profits are preferred as they don't increase debt. However, growth ambitions may exceed internal funding. Term loans, equity finance, or venture capital may be required. Each option has its own risks and benefits. Large organizations have access to a wider range of finance options. For short-term needs, they rely on working capital management. Long-term investments use debt, bond issues, or equity finance. Equity finance reduces financial pressure in high-risk environments. Sale and leaseback improves liquidity without disrupting operations. Different organizations have different financial needs. Internal finance supports stability and control. Debt finance enables controlled expansion but increases risk. Equity finance supports high-growth strategies but dilutes ownership. Contemporary methods offer additional flexibility. Effective financial management involves aligning finance with objectives. Finance choices impact operations and long-term success. Internal finance stabilizes operations but may constrain growth. Debt finance accelerates growth but increases financial risk. Equity finance supports innovation but reduces managerial autonomy. Contemporary finance methods improve access but involve higher costs. Aligning finance with strategy ensures sustainability. In conclusion, identifying and determining alternative sources of business finance is essential for supporting different business situations and stages of growth. Traditional sources such as bank loans and equity finance, alongside contemporary methods including crowdfunding, peer-to-peer lending, and venture capital, offer organizations a range of financing options. Evaluating these sources highlights the importance of selecting appropriate finance based on factors such as cost, risk, control, and business objectives. Effective financial decision-making ensures that organizations secure suitable funding to support operations, expansion, and long-term sustainability. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 074843616688.